Welcome. We will begin shortly. Hi, I'm Rashana Levin with Keller Williams Realty. So today's webinar is on being self-employed and buying a house. Yes, you can do both. So today's agenda, I'm going to talk a little bit about me, challenges for those that are self-employed, and looking at a self-employed borrower based on the lender's point of view, and talk about the programs that are available for self-employed buyers. So I have been licensed for over 15 years. This is year 18 in 2020. I'm at Keller Williams Realty. I'm licensed in Virginia, Maryland, DC. I'm also a real estate relocation professional for the military, and I'm also a notary public in Virginia. So challenges for self-employed. So they don't typically qualify for traditional loans because they cannot document their income, because you're trying to you have your business, so you can actually make extra money, or if that's your primary business, but you have had some adjustments to your income to have what's called tax write-offs. So the lender is going to use your adjusted gross income, and a lot of times, because you've had so many write-offs, you're not able to qualify. And also, a lot of times self-employed borrowers have low credit scores. Not all the time, but that's a challenge. So from a lender's point of view, you have what's called your net income versus your adjusted gross income. The adjusted gross income is what they're considering your actual income. And they're also going to look at the length of time that you have had what's called 1099 income. So it is easier to go for qualifying purposes. Say if you had a business for 2 years, and then now you're not you're self-employed. You are a W-2 employee now. Same line of work, but you're just not working for yourself. It's easier to go from 1099 to W-2 income rather than the other way around. Because if you had W-2 income and you switched to a self-employed income, then you would have to be in your business for at least 2 years and have 2 years of the income reported on your taxes, because they actually have to see that for 2 years, what's going on with the business. So let's say you made, $100,000 net income. And with your tax write-offs, your adjusted gross income is now $79,500. The lender is only going to allow you to use $79,500 for income verification. If the income is different over the past 2 years, the amounts will be added together and divided to come up with the final number. So that's important to understand that, because say this year you made $79,500 adjusted gross, but then the year prior to that, with all your expenses, you were at $48,000. So they're going to average those two together and come up with a number. So it's important to understand that. So qualifying traditionally and being self-employed. So you have to have been self-employed for at least 2 years. You have to have 2 years of taxes in the same business type. Your adjusted gross income is going to be counted. That is the amount after your write-offs on your taxes. And additional documentation will be needed from your lender as well. You can use first-time homebuyer programs. You can use those programs, but keep in mind that your qualifying is going to be based on your adjusted gross. That's the most important part. So if your adjusted gross is lower than the amount that you actually need to qualify for based on your debts, then you have to go with a non-traditional route, which let's get into that. So lenders have created different loan programs. All lenders don't have this program, but you need to be in the business for at least 1 year. They have what's called bank statement loans, so they are allowed. So they would want to see your bank statement. A couple different programs have 12-month bank statement program or 24 months. So it just depends. But it's something to keep in mind that your interest rate is going to be significantly higher because you are a riskier candidate because it's self-employed. So it's not necessarily guaranteed. I mean, we would hope, but that's not the case. So you're riskier loan to the lender. Those loans typically do not have private mortgage insurance, which is otherwise called PMI. And there are typically programs allow for 10% down payment, but keep in mind, the lower the down payment amount that the lender is going to request that you do, you have to have a higher credit score. If your credit score is on the lower end in the 600s, then be ready to pay at least 20% of what you're willing to purchase as a purchase price. So for more information on getting qualified for a self-employed loan in Virginia, Maryland, D.C., don't hesitate to give me a call at 240-284-4114. I didn't want to make this webinar too long because I just wanted to give you an overview about how to purchase a home with alternate financing if you're self-employed. Thank you so much. Thank you so much for watching. Have a great day.